I'm Gordon Scott here to talk about the U.S. stock markets. I have 4 charts I want to show you, which you're going to want to see, to explain what's going to happen in the next year in the U.S. stock market. Here we go. Now this first chart comes from a book that I co-authored with Tony Turner, published in 2013. It was in that book that I first gave this research, which explains how you can watch the utility sector and compare it to the S&P 500 to determine whether or not a bear market is imminent or conditions are ready for a bear market to appear. The research showed that if you see the utility sector outperform the S&P 500 at large for 2 consecutive months, and if during those same 2 months you saw historical volatility, that is regular price ranges as measured by the average true range, if you saw those things going up for 2 consecutive months, then there is a 90% chance that a bear market will occur in that following few months afterwards. Now, 90% doesn't mean 100%. The last time this lit off in 2015, markets went down about 3% more and then rallied all through 2016. So it's not always certain. And the market doesn't seem like it's about to crash from its recent lows right now. So what gives? Well, there are a couple of things about this, but with this signal having officially lit off, I'm a little more skeptical about the market conditions going forward in 2022. But I'm not the only one. This is Gina Martin Adams. She's worth following on LinkedIn, or if you watch Bloomberg News, you'll see her pop up. Anytime she gets on, you want to listen because she does good research. And she has a couple of charts that I think are worth looking at. Here's the first one. She did some research to say, what is the maximum drawdown that happens before a rate hike? And here you can see that in history, going back to 1973, anytime the Fed has hiked rates, what has happened right before it? Well, what's really interesting about this is the fact that where we are right now is the worst drawdown coming up in front of interest rate hikes. That's kind of interesting because it means that we might be in a temporary state of overreaction. We could see the market bounce up for a little bit. However, her next chart is this. She shows that what happens after rate hikes looks like this. The stuff before comes up to this point, and then from this pinch point right here, going forward, this is the historical activity that the S&P 500 plays out after there has been an interest rate hike, which is planned for right now in March. So you can see right there, the red line is the worst case scenario. The worst case scenario is only a 10% draw. So that's interesting, that after interest rates are hiked the first time, it only goes down 10% at the worst. I mean, who knows what will happen this time, right? But historically, the worst it's ever been is only 10% down. And that happens within the first month to 6 weeks after the interest rates are first hiked. So we're talking about from the middle of March to the end of April. Somewhere in that period, we could see as much as a 10% drawdown from that point. And then afterwards, it drifts higher. Not very much. The average return for the S&P 500 over that period of time from this point going forward is only 4%. So that's kind of dismal compared to what we've been seeing before. Even though we might not have a big old bear market crash where 20, 30, 50% or something like that, we could see muted returns in the US stock market. I actually love those years because I'm not a buy and holder. I'm a trader. And what happens in these years is that you get a lot of volatility, a lot of ups, a lot of downs. Markets that just go straight up, there's not a lot of volatility. They just kind of creep up little by little. But this kind of stuff, there's a lot of ups and downs, a lot of opportunity for short-term traders to capture big moves that swing and pop right back. So I think that's what we're in for in 2022 is it's a trader's year. Starting that off, check out this chart that I came up with for the S&P 500, where we are right now. Now, I'm not a big pattern predictor guy, but I do pay attention when patterns are telling me that trends are about to change, and it coincides with historical research like what we saw from Gina Martin Adams on the Bloomberg Equity Minute. Well, here you can see we've got a higher high and higher low. Now the low is about equal. And if in fact the price action fails to make a new higher high, that will be a head and shoulder setup. Now that doesn't guarantee that the price is going to go down. However, if it goes down, I mean, and this has all of the textbook setups to start. We've got, the higher up, this quick down move on high volume is a really big indicator of potential reversal. And the forecast is that if in fact it were to drop from this low, it would drop from the same distance that the high point of that down to what's called the neckline would be. And that is what this red line represents. This would equate to about a 10% drawdown. And if it were to come at that period of time, it would square just exactly with Gina Martin Adams' research, which showed that the worst case scenario could draw this down in about a month to this level right here, below 400 on SPY. Now, that's worst case scenario. And that's kind of exciting to me, the idea that market's not going to do any worse than that. If I were a long-term investor, I'd want to stay put in the US market regardless of what happens, if I thought I knew that this was going to happen. I am not a long-term investor. I'm a trader. And so I'm pretty excited about the possibility of capturing this and then riding it back up later on. Those are some of the things we're looking at ahead. Right now, between now and the time that the Fed plans to raise rates in March, then we're probably going to see a lot of pressure on stocks, a lot of herky-jerky volatility as different companies, similar to the whole Meta, Facebook thing and that Amazon thing, just the whipsaw back and forth of prices. I think more and more of that is going to come. And so there are a lot of opportunities. And what will that mean for the currency? Well, currencies are going to struggle because if in fact the U.S. markets are, if the U.S. Interest rates are going to increase, that's going to drive the dollar higher, and that's going to drive other currencies lower. So when I say struggle, I just mean relative to the dollar, other currencies are going to have more of a bearish tilt, would be my guess. And that's pairs like, the pound US or the US yen or the Aussie US dollar. So anything relative to the dollar will probably tend to show weakness throughout the coming year. And the big question will be, what will the central banks around the world do in relation to that? Will they leave their interest rate policies in place so that they can capture more of an advantage, an export advantage from being able to buy U.S. goods, or I should say an import advantage, being able to buy U.S. goods cheaply? Or will they struggle because now they have trouble selling goods into the U.S. market? And so they'll make a choice to determine, depending on what they do, whether they think they need to put stuff into the U.S. economy or take stuff out of the U.S. economy. And whatever they decide will determine their kind of interest rate policy and therefore how their currency performs. My guess would be that all of them will keep their interest rates lower than the U.S., which will put pressure on those currencies. They'll head down. It would be a good time to be long dollar currencies. Well, that's my read on it. Until next time, everybody, take care.